Welcome to Inside the Vault with SWP. Join Mark Yaxley as we explore the latest news, reports, and some bullion basics for investors old and new. Let's get to it.
Happy Wednesday, everyone, and welcome back to Inside the Vault with SWP, a weekly show where we dive into the world of precious metals and precious metals investing. If you've joined us before, thank you for your support, and if you're a new listener, welcome to the show. You can find our previous episodes on ANCAP Radio's Twitter account or posted to the SWP YouTube channel, along with a ton of other precious metals-related content. I'm your host, Jeremy Varlow, excited to be with you again today. We've got a great show in store. I'm typically joined by my colleague, CEO of SWP, Mark Yaxley, but Mark is off in Portugal for the annual LBMA Precious Metals Conference, where he is part of a contingent representing SWP. On today's show, we have Mr. Robert Prechter joining us for a chat. Robert is an accomplished financial author and stock market analyst known for his financial forecasts using the Elliott Wave theory. Bob will join us in just a moment, but before he does, let's jump into our weekly market update discussing the metals markets over the past 7 days and the top stories that we are following around the globe that affect precious metals prices. As we know, metals have rebounded in recent weeks despite a consistently strong US dollar, higher bond yields, and Fed policy decisions. As we've seen, the ongoing conflict in the Middle East has been a key driver of recently higher gold prices, but the aforementioned dollar strength and higher yields have begun to unwind what we call the war premium on the safe haven asset. Gold dropped to its lowest levels in 2 weeks while still trading more than $100 above pre-Hamas attack levels, down 2% in the last week to $1,956, while silver is down just over 3% in the past week, trading at $22.71. Further in macroeconomic news, the U.S. Federal Reserve kept its interest rate target unchanged this week, which was widely expected, but with the Fed Reserve Chair Jerome Powell stressing that future rate cuts had yet to be considered. To quote Powell, "The fact is we are not thinking of rate cuts at all right now. We're still very focused on whether we have achieved a monetary policy that is sufficiently restrictive enough to bring inflation down to 2% over time sustainably." All eyes will be on the Fed decision in December, with early predictions of a pause in rate hikes topping 90% in certain polls. A relatively light week for macro news and events, with a few to monitor in addition to the geopolitical headlines. Jerome Powell will be part of a monetary policy panel at the IMF conference tomorrow. U.S. trade data and initial jobless claims will be later in the week. So with that, let's bring in our guest, who surely will have some insight on what we've just spoken about and is definitely more capable than I to make sense of everything going on. Mr. Bob Prechter is the founder and president of Elliott Wave International, the author of 18 books, including the 2002 New York Times bestseller Conquer the Crash, as well as the popular monthly newsletter on the Elliott Wave theory called The Elliott Wave Theorist. Very excited to have him with us today. Welcome to the show, Bob.
Thanks, Jeremy. Good to be here.
Great to have you. Let's jump into things. I know our audience is very excited for this. I take a lot of calls at SWP from people who follow you, read your material, and whose investing frameworks you've helped shape over the years. We've got a lot to pack into roughly 20 minutes here, so let's jump in. Many know your work as it pertains to the Elliott Wave theory of investing. If you could just distill it down to us in its simplest forms for someone unfamiliar, what is the Elliott Wave theory?
Well, a man named Ralph Nelson Elliott back in the 1920s began studying the market, and he found that there seemed to be a form to it. He didn't have the word at the time because it came along much later, but what he described and drew out was a fractal, where the market would move in a series of waves, both in the direction of the main trend and against it, that made certain patterns, and then he found that the components of those patterns were the same. And then he found that the patterns were, in turn, components of larger moves. So the whole thing was described as a nesting fractal, and that's our model. You know, we could go into the details of it, but I think in 20 minutes we probably should avoid that. So we think that psychology is the driver of markets, mass psychology, and people, for the most part, are herding. They don't have any basis to make proper decisions about market ownership and prices. So they look to each other, and because nobody really knows, you end up with a pre-rational herding impulse, and that is why it adheres to a model. So we try to follow that and look at waves develop so we can determine when people are overly optimistic or overly pessimistic and make decisions on that basis.
So that ties in really nicely to my next question for you. You've authored a book on a theory you've developed called the Socionomic theory of finance. I dug into it a little bit yesterday, and it's fascinating and kind of counter to what everyone else thinks, how the markets move. You propose that economics and finance are actually two completely different fields, and I actually have a bit more of a definition here, but I feel like, you were kind of alluding to it just there. I'm going to defer to you to describe it because it is really quite fascinating.
Yeah, economists, have theories about how the economy works, and for the most part, they're correct, especially at the microeconomic level about incentives, so forth. But then they try to say financial markets work the same way. They work on supply and demand and so forth. And we say, no, there's no supply, there's no demand, there's no equilibrium. None of the things that apply to an economy apply to financial markets. Financial markets are driven by herding behavior. It's completely different. It is something that originates from human minds. It's not originating from outside that people react to or adjust to. It is their own minds forming, herding in one direction and then herding in the other. And we've got a lot of evidence for that throughout that book. It's 800 pages, so it takes a while to get through it. But I think once you're done, you say, okay, I get it.
Yeah, that it's incredible, and like I said, is completely counter to how you expect markets to move and what drives them. If I'm getting this correct, what you're saying is in traditional free market economics, the prices of investment should be based on supply and demand, but you're arguing with the socionomic theory that the price of investments is far more based on, I guess you'd say, non-rational or subjective social moods. Is that correct?
Yeah, non-rational is what's making markets do what they do, and that's why people are often completely amazed at extreme overvaluations and extreme undervaluations. It also explains why when, for example, prices are very expensive, everyone wants to own it, and when prices are cheap, no one wants to own it. That is a rule in financial markets. It's the exact opposite from economic markets. In economic markets, when there's a sale, everybody rushes in because they want to buy it. Hey, things are cheap. This is great. And when things are expensive, they stay away. Financial markets are the exact opposite, which proves that they cannot be using their rational minds. Otherwise, they buy low and sell high. But they do the opposite.
Yeah, you're so right there. And I mean, it's something that we've seen, in the precious metal space in recent weeks. The last couple of months we've been trading at lows, for gold in the low 1800s, which, historically would be a great time to, start to level into to gold. But it wasn't until, the recent conflict in the Middle East and the price started appreciating that investors started reaching out to us and, kind of wanted to jump on board as the price was rising. So that does make a lot of sense.
Your business is just similar to all the others in the financial area. You can't find a customer when prices are low. Right. And when they're high, they're beating your door down to buy them.
Yeah, the human psyche is a very interesting thing to study. That's fascinating, and it makes all the sense in the world.
Yeah, and it's the complete opposite of Walmart. When they have a sale, everybody comes in. They get twice as many people. So that's the difference between economic motivation and financial motivation. In fact, I'm sure we're going to talk about gold and silver sometime today, and we have the commitment of traders reports, which track trend followers, and also a group called the commercials, and they behave completely differently because the trend followers are speculators. They're viewing gold as a financial market, and the commercials view it as an economic market, and they actually do buy when prices go down. And they're a very small set of people, but they have a completely different motivation, and you can see it in the way they behave.
I think you've just changed my investing framework. It's now make your investments as if you're shopping at Walmart. I think that's what I'm taking away from this right now.
Exactly. And almost no one can do it. Certainly the crowd can't do it. I mean, the whole group.
Right.
They are the herd, and to separate yourself is difficult. I think it was Keynes who said the market can be ridiculous longer than you can stay solvent, or something like that. So the herd often, when it gets going, just runs and runs and runs beyond all rational valuation measures, and then on the downside, it gets oversold and then keeps going and keeps going, and people can't understand why their favorite investment is getting cheaper and cheaper, and it's just hurting until they're exhausted in the other direction.
Right. I think the exact quote was, "The markets can stay irrational longer than you can stay solvent." If I'm correct, I wanted to move on and just ask you. You were obviously a proponent of the Elliott Wave theory. It seems to be, and I might not be giving it enough credit here, it is incredibly intricate to understand, but it seems to be guided by a set of rules and guidelines. How do socionomics play into the Elliott Wave theory as it seems, for lack of a better term, more chaotic or impulsive, when it comes to socionomic moods?
Well, way back in 1976, I was thinking about some of the cultural changes going on in music and movies and things. And I began to realize that the tone of music and movies and politics and things like that seemed to be changing with the ups and downs of the stock market. And that's when it sort of hit me. There's got to be an underlying cause of all this. And I lit on the idea that there are such a thing as waves of social mood. And that's what R.N. Elliott was describing. Now, he saw them expressed in stock prices, but they're also expressed in other ways. The kind of music people listen to, the kind of movies they like, the kind of entertainment they want to see, and who gets reelected. We did a study that was published in an academic journal linking the stock market to whether or not an incumbent running for U.S. president wins or loses. So I think presidential popularity is tied to it as well, and it's all an expression of social mood, which in turn is completely non-rational. So people may talk for hours about why they voted for this guy or that guy, but most of it's run, certainly the aggregate, is run by people's mood. And it has practical use because just before the last election in 2020, I think it was 2 weeks before the election, I wrote an issue of the Elliott Wave Theorist, and I said, you should vote for the candidate you like the least. Because we were so overvalued in stocks. I said the chances of a bear market occurring while the next person is president are very, very high, and that means he's probably going to suffer a big decline in popularity. Well, stocks are well off from their highs of November 2021 and January 2022, and you can see the current president's approval rating getting worse and worse and worse. So I think that social mood is beginning to turn a bit more negative, and it shows up in his popularity numbers.
That's very interesting.
Not that he doesn't deserve them. That's a whole other question.
Fair enough. So just following up on that, and this is coming from somebody that's trying to, understand Elliott Wave and socionomics myself, how do, large kind of black swan events like a global pandemic or geopolitical conflict like we're seeing now play into something like the Elliott Wave theory? It's something that can't be predicted, something that comes out of seemingly nowhere. Again, it seems like the theory is defined by a set of rules. So how do these events disrupt that theory, or do socionomics then come into play even more in these cases?
Yeah, that's a great question, very insightful question. Most people think that black swans are causal. They happen, and then markets react, and there you go. But under the wave principle, it is those times that can more or less be predicted. That's why I said, for example, vote for the presidential candidate you like the least. Now people are saying, oh, look at all the reasons why Joe Biden is less popular than he was. So the reasons come out later. Now, the market topped in January 2018. It went down, it went up, it went down, it went up into early 2020, in fact, mid-February. And we were due for one more decline in a picture that's called a triangle, an expanding triangle. So we were, ready for a big decline at that point, and the market had one of its swiftest declines of that amount ever on record, and suddenly the pandemic hit. The last time we had a terrible pandemic was, of course, the influenza of the teens, 19 teens. That was during a bear market period. So how could that possibly be caused by psychology? Well, I think when social mood turns negative, people become less happy. They become more depressed. They may not exercise as much and may not do a lot of other things. And they're more susceptible to extreme events such as, getting sick. And you can have epidemics and pandemics, and we've tied virtually all of them to that kind of period in social mood where it's turning negative. And notice that even though we had this terrific pandemic and it lasted for a couple of years, the stock market bottomed way ahead of the end of the pandemic. So, why was that causal? Did the pandemic make stocks go all the way back up to a new high? I don't think so. So, you can try to explain those things as causal, but ultimately, if you look at them really carefully, you find the market's doing its own thing and seems to ignore a lot of these fundamentals as well.
Thanks for that, Bob. So just kind of playing off that, and let's, get a little bit more current here, I suppose. I watched your recent podcast on the Elliott Wave International YouTube channel yesterday. Loved your answer to this question about where the markets are right now and where we're heading. Obviously, everyone's talking about inflation, but there are some that are, speculating that we are headed for a deflationary period. I wanted to get your insight on that.
All right, well, from 2021 right through the present, with the exception of a few months last year, it's been an orgy of optimism toward the stock market. And you might not believe that because politics are so divided, but we had something very similar in 1968. You had the Democratic National Convention and protests and everything crazy going on, and yet stocks were driving to higher highs all the time into December of 1968. So there are times when mood is extremely positive and stocks are holding up, and yet there are areas where there's the beginning of conflict is occurring. I think what we've had is extreme optimism. I've got, I put out a report in November, it was December 2021 called A Stock Market Top for the Ages. Mm-hmm. And I showed, I think, 24 different indicators that we have been showing all that year, 2021. Every single one of which was not only at an all-time extreme, reflecting optimistic valuation of stocks, but usually by many multiples above previous tops, such as 2000 or 2007. In 2021, it was just crazy the way people were pricing stocks. They're still in kind of a mania mindset. You see, the past week when there was a sharp rally, everybody dove into the tech stocks again. But if you look at the Russell 2000, you can see that the average stock across the spectrum has been driving to new lows, and new lows. So the stock market's in a bear. There's no question about that. But the optimism of the average investor has not cracked. And you can see that even in the price of junk bonds, which are still yielding just a little bit more than treasuries. So obviously, nobody in the financial realm, or let's say few people in the financial realm, are afraid of anything. And you can see it in the fact when they come out with a new ETF. And what's the ETF going to do? It's going to trade zero-day options. Mm-hmm. You can't get that at a major stock market bottom. There was a bank that just came out a month ago and said, you'll be able to trade stocks on our new app for only $10. And that's not $10 in a commission. You can invest as little as $10. So they're going down. That's below the shoe shine boy of the 20s. They're just going to the lowest possible common denominator. So I think stocks are ridiculously overpriced. But because the Russell 2000 is leading the way down, it's telling me that we're in a bear and people are slowly beginning to move out of stocks and into money. But what's money? Money is the dollar. The dollar's been strengthening ever since the stock market got weak. Interest rates have gone from 0 to 5.5% on T-bills. Those are money investments. And as part of that, I think gold. Gold is real money. And I think people are beginning to say, we'd like some of this stuff rather than the traditional investments. And that's what the big tidal change that started in 2021. It's still very slowly occurring, but I think next year it's going to start slowing.
Yeah, that's perfect. I was going to segue into the metals on the back of that question. I noticed that, in the early 2010s, you made some interesting calls about both gold and silver. I was shocked actually to know that the Elliott Wave theory is applicable for even precious metals. I'm wondering what you're seeing with precious metals prices right now. You kind of alluded to it, but what you expect over the next 6 months to a year.
Okay, I'm going to start by just reviving something that we had said back in 2012. If you remember, gold had topped in 2011. It had rebounded. It was holding up very well until late 2012. Now, we counted that as wave 1 down and 2 up, and we said, the market's going to go down. So what happens? Ben Bernanke comes out and he says, we're going to start buying $40 billion worth of treasury bonds every month with no end in sight. And a month after that, he comes out and says, now we're going to add to that $40 billion of mortgages every month with no end in sight. And a lot of gold bugs are saying, oh my God, this is nirvana. Here we go. Gold's going to go to 10,000. And our headline was, Bernanke announcement, last chance to sell gold. Nobody would say that except the Socionomics, because we're looking not only at Elliott waves, but also the extreme optimism. And by the time that was announced, if somebody wasn't long gold, he wasn't listening to the so-called fundamentals, right? So everybody was invested. And sure enough, gold went down and down and down. The entire time that Bernanke was doing his so-called QE program, creating more money out of thin air, and it went all the way down, I think, until December 2015, if I recall. So it even not only went down throughout the entire program, but even for a while after the program was over. And people didn't understand it. But that's because herding is in charge. It's not outside events, occurring like earthquakes and causing things to happen. Now, okay, so what about today? As you know, gold's been fluctuating up and down, mostly going sideways for a couple of years. And we haven't said much about it. But recently, we started getting very excited about it, down around in the 1850s, I think it was, because we counted 5 waves up from a low, and we said, okay, that defines the next trend as, the big trend is up. And at the same time, the large speculators, there are 3 contingents in the futures markets: large speculators, small speculators, and the so-called commercials. So you would think the large speculators are really brilliant people and they always make money, but they don't. They act just like the small speculators. They are trend followers. So when gold got weak, they got out. And the commercials started buying more because, as you said, they were buying it like they were in Walmart. Oh, gold's cheap, let's buy some. And you know what? The large specs still have not returned. So we think gold is going to go up until they do, because they are trend followers. If it goes up, they're going to chase it. They're going to be heavily long. There's no guarantees about this. But if they were heavily long now, we'd say, watch out, gold's going to have a big fall. But they're not. They're cautious. And when they're cautious, there's a better chance gold is going to go up and down. We also have the wave count. So we think over the next year, there's a good chance gold's going to go to new all-time highs.
Fantastic. That's great news for us. We like that. I wanted to ask you one more thing just off the tail of that. You're a proponent of having exposure offshore. I'd love to get your thoughts on, how investors can safely do that. Any best practices that you have in mind for those that are looking to diversify jurisdictionally.
A couple things that I recommended in Conquer the Crash. One is an offshore bank. You want one that's highly liquid. So I think I located one that fits the criteria. And they are very cautious, and they follow all the rules. I mean, they're regulated and everything else as well. But they're not, they're not in the U.S. banking system. So if the U.S. banking system has a real problem, I think it wouldn't be a bad idea to have some money offshore, because in the U.S., the insurance, so-called insurance program, FDIC, can pull money out of healthy banks to shore up the sick banks. You don't want a bank tied into a system like that. You want a bank that's offshore. Well, it just so happens the bank is located not far from the headquarters of SWP. And when I found out about SWP's storage faults, I thought that was a terrific idea. Again, it's offshore. There have been some incidents onshore when people thought they had their metals stored safely, and they didn't. So I think offshore storage is a really good idea, and I like the way SWP is managed. And I think the prices you charge are reasonable, and it was terrific that we could come to a bit of an agreement so that people who read Conquer the Crash or came from Elliott Wave, being an Elliott Wave International customer, would have a landing page at SWP Cayman where we could give them a little better, even a better deal. So, yeah, we've got a couple of addresses that we could mention for people if you like.
Yeah, absolutely. I was actually going to come to that in just a minute. I just want to ask one last question. You mentioned talking about, offshoring to protect yourself in the event of a bank crisis, potentially. And that brings up a different asset class that I know that you've spoken about and written about, and that, of course, is Bitcoin and digital assets. Bitcoin, to someone like me, just learning about socionomics, seems like it has all of the makings of a social mood. I'm active in the space myself, and the overarching theme there is a group of people wanting freedom to transact. Does Bitcoin follow the same kind of theories of socionomics and Elliott Wave?
Absolutely. In fact, Bitcoin came on around 2009, and my son, who went to MIT, he's gotten interested in finance, and he told me about this thing called Bitcoin, and I had not heard about it. At the time, it was trading at 6 cents. And I said, this is fantastic, because Bitcoin could be private money. It could be, out of the grasp of regulators. Once the Bitcoins are all created, there can't be any more inflation. In fact, it would be net deflationary forever because people would lose coins. I said, this is the coolest idea I've heard of in a long, long time. So we wrote it up in the Elliott Wave Theorist. He wrote the essay about it, and I did some editing with it, and we ran it. We said, this is a really cool idea. So we had no clue that this was going to turn into a giant casino. But, it started at a penny. And we said, it's 6 cents. This is really good. You should look into it. And then it goes to $6. And we go, wow, that's pretty something. Then it goes to $60. Then $600. $6,000. And at each one of those times, we're like, this is unbelievable. What happened was, in the fifth wave up in the stock market, which started in March 2009 and ended in January 2022, Bitcoin became sort of the sidekick place to gamble and invest. And it went from a penny to $70,000 per coin. That is a 7 million times multiple. The people talk about the tulip mania. I think that was about a 10 times multiple or something. Nothing. This is 7 million times. And it counted 5 waves up. We think the whole bull market is over. An incredible thing happened along the way. Well before the top, it was discovered that Bitcoin's blockchain couldn't really handle worldwide business. It got too slow. And we thought, if you look at fundamentals, right, that should be the kiss of death for Bitcoin. But it wasn't. Why? Because the herd wasn't done. Back to the Keynes comment. So it went up and up and up, and finally seems to have topped at 70,000. So Bitcoin was just a fellow traveler on wave 5 up in the stock market, propelled entirely by social mood. And if you remember that the last 7 or 8 months of the bull market, people even started buying something called NFTs, non-fungible tokens, which are these cartoons, and they were as much as $1 million a piece. And we said, this is insane. People are buying zeros and ones and paying millions of dollars for them, and you can just snap a picture of it yourself, and you've got it. And that thing completely collapsed. Well, I think Bitcoin is on the way. Collapse is a strong word, but I think it's going to have a very long bear market because if someone else invents a better coin that doesn't have the blockchain issue, and maybe it'll be Bitcoin figuring out how it's going to handle it. Okay, fine. But I think the herd is now in the other direction, and it's going to be going down a long, long time before it hits bottom. At least that's our view.
That's fascinating. Thank you very much for that insight, Bob. I appreciate it. I wish we could do this for an hour. I think that there's just so much that we can learn from you, and I think, potentially we can reschedule a little bit longer chat down the road. It's incredibly insightful. For those that want to follow you, learn more about the Elliott Wave theory and socionomics, where should they go? What should they follow? Give yourself a little bit of a plug here.
All right. Well, we set up a special landing page for SWP followers. We make some offers. We know they're gold-oriented, but we've also got some other things they might be interested in, like Conquer the Crash. I think we're giving them like half off or something if they want to buy it. So they can go to elliottwave.com/SWP. And Elliot has 2 L's and 2 T's. So it's Elliot and then wave like on the ocean.com/SWP. And once they land there, they can poke around the website all they want. We have a lot of free stuff and videos, and they can learn a little about us.
That's awesome. Thanks for that, Bob. Bob Prechter, ladies and gentlemen. Bob, thank you very much for being on the show. We appreciate your time.
Jeremy, listen, I have to tell you, I appreciate the fact that you actually picked up Socionomic theory of finance. That's terrific. That means you do your homework, and that's pretty rare these days. So thanks for a good interview.
I appreciate that, and I certainly learned a lot, and I will continue to dig deeper into it because I feel like I've fallen victim to the opposite of buying low and selling high myself in my early years.
Okay.
All right. Have a great day.
Good luck to you and everybody there in 2024.
Thank you very much, Bob. All right, as always, we finish our show with our Bullion Basics segment, which of course is a quick hitter designed to answer some of the most frequently asked questions in precious metals investing. Today, we are going to talk about holding metals offshore or in alternative jurisdictions, as Bob just mentioned. Now, obviously, when purchasing metals, you want to first understand your motivation for doing so, be it wealth preservation or protection or any other reason, which metals are right for your investing purposes, gold, silver, coins versus bars, etc. Now, when considering offshore metals investing, security is obviously essential since there may be considerable distance between you and your metals physically. Fully allocated, completely segregated, and 100% insured holdings will provide you the peace of mind that you need. Further understanding the costs associated with storing or vaulting metals abroad, as there may be additional costs for management or fees associated with selling your metals when the time comes. And of course, and possibly most importantly, always understand any tax implications. Seek the advice of tax professionals for holding metals in a different country. That is our Bullion Basics segment. In a nutshell, that is all for us today. Thank you to everyone for listening, to ANCAP Radio for partnering with us, and to our guest Bob Prechter for joining. Mark Yaxley will be back with me next week, giving us a recap of the LBMA Precious Metals Conference in Portugal. For more information on precious metals investing, you can visit our website at www.swpcayman.com or the Strategic Wealth Preservation YouTube channel. Also, go check out Bob's website that he mentioned earlier. Until next week, stay safe and happy investing.
Thank you for listening to Inside the Vault, the podcast that opens the door to precious metals. We hope you learned something new and enjoyed the show. See you next time on Inside the Vault with SWP.